For more on what to expect from the Fed and the barrage of eco data that we've gotten today, let's bring in Schwab Asset Management CEO Omar Aguilar. Omar, it's great to have you. Are you encouraged at all by these? Do you trust the kinds of prints that we've gotten, not just with PCE, but German, Eurozone CPI, Italy's PPI, all these disinflationary trends this week?
It feels, very encouraging to actually see that the trend towards lower inflation seems to be confirmed by all the data. I got to believe that, people at the Federal Reserve and central banks around the world are thinking the same way, that, their job seems to be working in the way they want to. I do think that, going into the second part of getting close to their 2% target is still in their biggest concern, and how they can get from where we are inflation-wise, even with these trends, especially when you have a significant amount of headwinds going into next year.
Isn't the more sinister story, though, the idea that these yields, especially long-term yields, are rising not on inflation, but on supply, and Japan and China cycling out fewer dollars, deficits and downgrades, that idea that structurally you could wind up with higher rates even with the economy softening?
Well, that's the biggest discussion that we have had over the last, couple of weeks, which is precisely what is the driver of these, yields going higher. Clearly, on the short end, it's always driven and controlled by the Fed and central banks. As you think about the 10-year yields and even longer duration, big parts of the way you describe it is usually tend to do about economic growth, which is not the case now because we're decelerating globally. If you actually think about inflation expectations, and we just said it, no, that's actually going the opposite way. So the only explanation of that extra increase in volatility of yields has to do with the supply-demand imbalance that we see around the world. So when you put all the three pieces together, our big thesis this year is that we need to see some stability on the yields before we can see a little more clear, path for the economy as well as just for equity markets.
All right. So until then, you stay defensive. How do you play it?
Yeah, well, we've been encouraging our clients to just be, barbell. When you think about equities in its own, there is really still risk around the potential, disinflation and the effects of higher yields. Every single valuation today will point towards the change of the denominator for any valuation metrics that any fundamental analyst could have, given that interest rates are still rising. So when you think about that, and you think about the value that you see in equities relative to the risk premiums that you can have, you got to still figure out that there is the potential that the soft landing scenario may actually turn more negative than what most people think. So in that sense, we continue to encourage clients to have a portion of their portfolios to be more high quality, a little more defensive, while at the same time start thinking about that if we are in the camp of these rolling recoveries, that there should be some portion of their portfolio that start positioning themselves for a recovery in more cyclical stocks, high quality growth that could potentially take them to the next phase of the recovery into next year.
Omar, it's a good take as we wrap up the quarter. What a quarter it's been. Good to see you. Have a good weekend. Omar Aguilar.